Hey everyone, thanks for joining us today. This is Hunter Satterfield. I am one of the partners here at CWA, as well as the Chief Investment Officer. As always, I am joined by my fellow partner, Brian Bortz, who heads up our investment committee here at Kane Waters, as well as Brad Sanders, who is the Managing Director of Tectonic Advisors. This is your September market update. The month of September was a tough one. The S&P 500 was down 9.2%, global stocks down 9.7%, and then domestic bonds and global bonds both down 4.3% and 5.1% respectively. So really no place to hide. A tough month after a tough year, and it echoes much of what we've said on these video feeds over the course of the past 9 to 12 months, that we're going to have continued volatility, and that continues to persist. And so, Brad, I'd love to kind of start with you. Obviously, the kind of dying question is what caused this here in the month of September? So what are you and your team seeing as far as, kind of what drove this move down?
Yeah, we've just kind of reached a little bit of a capitulation point in the market where everybody is staring at the CPI numbers and trying to extrapolate from that what the Fed's going to do. And we've reached a point where both good and bad news are bad for the market. Okay, so in September, the Fed raised rates 75 bips, and after we'd seen the inflation reports, that was already priced in. But they used tough language again. And then a week later, we got the PMI report, and the PMI report came in better than expected. And that's what sent the market cascading down, because the PMI is the manufacturing index. When everybody saw, the manufacturing's good, it's better than expected, that means the economy's still hot and the Fed's going to keep raising rates. And so everybody's kind of staring at these data points and trying to guess what the Fed's going to do. And really what's underlying all the major volatility is it's caused the dollar to get super, super strong. Strongest US dollar in, 50 years. Somebody would have to fact check me on that, but it's got to be. And when the dollar gets this strong, it just wrecks shop globally. If you've seen the news out of what the Bank of England had to do with their currency, if you look at what's happening overseas in Europe and in Asia, the strong dollar is just causing a major dollar funding crisis. And it's causing massive problems to the point that the UN, of all governing bodies, came out yesterday and asked the Fed to stop raising interest rates. Okay, so when you have a dollar this strong, it acts as a mechanism to export inflation overseas because it's the reserve currency, right? So a stronger dollar means everything that people need to live gets more expensive. And it just causes problems overseas, because if you're in another country and you need to buy oil and you need to buy wheat, those are priced in dollars. So you have to go find dollars that are getting more expensive every day while your currency is weakening. And so it makes those commodities more expensive every day, which is a form of inflation. The good news is if we could get like one CPI print that was worse than expected, so worse to the good side, meaning negative, it's going to reverse trend in the market, and it's going to reverse trend for everything. So that would be good for the bond market. That would certainly be good for the stock market. That would cause the dollar to weaken up. That would likely cause the yield curve to be less inverted, and you would get the market a chance to breathe. So that's really all we need. But that's what's going on. I've been talking a long time about the strong dollar. Really, you can kind of ignore all these other CPI prints, PMI, all that stuff. If you could just find a Bloomberg terminal, pull up the chart of the dollar and see which direction it's going, that's the direction the markets are going to go. Over the last, we're filming this on the 4th. We had a major upside in the market yesterday. Market opened big today. And if you look at a chart of the dollar, it's down, so that's really the major trend we need to watch.
Yeah, it's obviously it's a tough sort of place, Brian, as I come over to you. It's a tough sort of place because of all the things that Brad's talking about for investors to sit in the market and say, okay, there is no place to hide. I mean, I guess one of the big questions that, a lot of my clients and a lot of your clients have had is, is there some sort of light at the end of the tunnel? Do we see something to where we can say, okay, now we can see the market moving up? What kind of conversations are you having with clients when they ask that question?
Thanks, Hunter. Yeah, that really is kind of been the message here for the last almost month. We just had our investment committee meeting, as the two of you are aware, since you're both in there, and we talked a lot about kind of timing of what we think when this thing starts to turn around. The difficult part is it's probably 6 to 9 months out. If you look at the average duration of a recession, it's 17 months long. And, you say recession and no one's admitted that we're even in a recession yet. I think it's pretty clear that we are. But, you look back and say, okay, what's going to lead us out of this thing? And we discussed how the CPI, the inflation index, has appeared to maybe peak. We'll see. As Brad said, if we could get just one good number, unexpectedly good number to come out, that I think that would be really good news for the market, especially the bond side. The other thing that we talked about was the difference between stocks and bonds, and how bonds, if you hang on to them, bonds will mature at par. So if the aggregate index at this time of filming is down almost 14%, then you end up having some rebound from the bonds, which a lot of our clients hold as well. So there's a lot of good things that are coming. Unfortunately, we just kind of have to sit here and work our way through it. We also discussed, and I got some information from Brad the other day, looking at market lows. And so since 1932, which is 90 years, there have been 26 18-month market lows. And those market lows predominantly occur in October. And so when you look at this chart of months, almost every other month has one or two 18-month major market lows. October has 9. So, we should be nearing the, it's always darkest before the dawn, so to speak. We should be nearing that point. And so when you look at the recovery, you have a lot of things that are moving in a stronger economy that are optimistic for where we're headed here in the next 6 months.
Yeah, thanks for that, Brian. I mean, ultimately, it's the consistent message that we've talked about all year, which is sort of this just increased volatility. And, Brad, from your perspective and your sort of, team of folks that are looking at this, is a lot of what Brian is sort of talking through, consistent with what you're seeing on data as well?
Yeah, the market's tremendously oversold in the short term. So all that means is that the markets drop too fast, too quickly. And when you see markets that get oversold in the short term, you definitely don't want to be capitulating into that or panicking and trying to sell. You definitely want to let that kind of come back to you before you start repositioning your portfolio or making any kind of longer term decisions, because markets can get this way. When the market goes bidless, like it was particularly in the last week of September, you just get areas where the market doesn't mean that the market's not even unfairly valued here. I don't know if it is or not. Even though if we're going to have a recession, it's probably fairly valued, but you can overshoot that to the downside just by people panicking, and you don't want to be participating in that. And also, just because I don't want this thing to be tremendously negative the entire time, Brian mentioned the IC. We spent a predominant amount of time talking about some new opportunities we have. And, the market has been so volatile and has gone down so much so fast. We have a whole different opportunity set that we didn't have this time, even last year, right? Where there's a lot of stuff that's super cheap that we couldn't have bought last year based on our valuation criteria, that we're going to be able to buy in size sometime in the next 6 to 8 months. It's probably going to get cheaper. There's one area we think it might be a generational type buying opportunity. So it was pretty upbeat in there because we're looking, we're all managing against long-term financial plans. There's a lot of stuff we're going to be able to put in the portfolios. It's really going to help our return streams for the next 10, 15 years that we're going to be able to buy, sometime in late 2022, mid 2023, somewhere in that time frame. And we're pretty excited about that. The last 5 years has been, guess what the S&P is going to do? Now we have all kinds of stuff we can buy and you don't have to play that guessing game because you're buying at good valuations.
Yeah, no, thanks for that comment because it's absolutely true. I mean, again, we will have continued volatility. I mean, we've got major geopolitical risks going on in the global economy as well, both with potential war and energy crises and things like that. But at the end of the day, despite that volatility, to Brad's point, super optimistic about the future. So thank you everybody for joining us today. We will be back in front of you at the end of October.